Hi, everyone. My name is Alex Sunners. This is my colleague Jackson Courtney. Today, we're going to be talking about investing, one of our favorite topics.
That's right. We talk about it all the time, and we could talk about it all day, but we've got about 30 minutes, 20, 30 minutes just for you today.
Yeah, and
So
it's a really good time to talk about this. We've had some recent volatility in the market, so I think it's a really good, important time that we can explain really what's going on, not specifically in the last week what's going on, but overall when someone looks at the markets, some people might say, "Yeah, I know the ins and outs of it," and some people watching are saying, "Yeah, I really need to know more. And why do markets do what they do?" And hopefully that's what we can answer today.
absolutely. I think, like you said, it's a great time. We look at markets a lot. We look at markets every day. Our clients maybe not so much, but we try to watch the markets and take in all the information and see how it's going to affect our portfolios and investing in general. So that's what we're going to talk about today.
Yeah, and I think it's really important. I think the first thing we want to talk about is just timing the market. And I mentioned
Right.
how it's a good time to talk about markets because of recent volatility, but that doesn't mean it's a good time to either buy or sell things because there is volatility. We have found that timing the markets is incredibly hard because you don't have to be right once, you have to be right twice. You have to know when to buy and when to sell. So timing the markets can be difficult. What we like to say is time in the markets is going to beat timing the markets. What essentially that means is if the market's going up, we're not buying and selling on the way up and on the way down. We're just trying to buy and hold throughout the duration of the market cycle.
That's a great point. And also, if you think about it, the best days in the market could potentially be in a down market. When markets start to find that trough, start to find that bottom, that's when you can start to see single days or single weeks where
Mm-hmm.
markets really pop. And if you're trying to time it and go in and out of it, chances are you're going to miss those top five performing days or top 10 performing days that really end up calculating to be most or half of your return for a single year. So, like Alex said, if you're trying to time markets, you have to be right twice, and we think that's incredibly difficult. So, time in the market, if you're still contributing to your accounts, maybe your dollar cost averaging, so you're contributing at tops, at bottoms, without trying to time it and just trying to keep your time in it expanding. We found that to be an effective strategy.
Yeah, and I think just if we just take a step back and before we even dive into some things, we have to define what investing is. Why do we invest? I think a lot of people accumulate their money and they know to invest, but some people might be asking, why should I invest? I know we've had clients that have come in and their entire portfolio is cash.
Sure.
They either have money in their 401k that's in money market, they've got the stereotypical money under the mattress, cash under the mattress, and they are scared of the markets. And markets can be scary, but if you look at them in a academic way, an intellectual way, you don't have to be scared of investing your money. And let's do an example.
Mm-hmm.
So if we have a client and let's say they have $1 million,
Right.
if all of that money is in cash, right now they're earning 4%, which some people might say 4% return. Yeah, I can live off of $40,000 per year off that $1 million.
Sure.
But what happens a couple of years ago when you're earning next to zero? High yield savings accounts are earning 0.5%. Now, what are you saying? Well, that cash is doing nothing for you. That cash is trash. So we have to think about what other ways can we get return? And a big way to do that is investing in markets. And whether that be the stock market, whether that be the bond market, whether that be investing in alternatives,
Mm-hmm.
things that are not stocks and bonds. There are a variety of different things you can invest in that's not just on the sidelines in cash.
That's absolutely true. And I think also a good point that you made is that cash over time really is a bad investment. If you have cash and you have high levels of interest rates or high levels on your money market, then yes, you can be returning 5% or so, like we've seen in 2023 as the Federal Reserve has increased interest rates. But at the same time, if you're experiencing levels of inflation like
Mm-hmm.
5, 6, 7, even 8%, like we saw in the upper end, even though you're receiving a little bit extra interest on your cash, you're still earning less of a rate than just the basic rate of inflation.
Yeah.
So that can be, that's kind of a reason why, we turn to things like the stock market, right? If inflation increases, then it means that companies are potentially making more in profits because they're selling more, people are buying more, the economy's going strong, and these profits turn into earnings for the company. They turn into higher prices for these investments. And we think that stocks over time have done a great job of keeping pace with inflation in comparison to cash. Um, so yeah, like you said, using a mix of different asset classes like stocks, bonds, alternatives, and maybe have, in 2023, maybe having a portion of your assets in short-term cash where
Yeah.
you can be yielding a higher rate right now, but not for the long term to have most of your portfolio in something like cash.
Yeah. And it's never too late to start investing. That's a common misconception is if someone is older, let's say they're 50 years old and they don't have a lot of retirement savings, they say, well, I'm just going to accumulate everything I can in the bank because it's too late for me. I can't retire and invest all this money. Well, it's never too late. The best time to start investing was yesterday.
Mm-hmm.
The second best time is today. So a lot of people think, oh, I missed out on all these past returns. Well, there could be future returns. We don't know what that future holds. And if you can do it in a systematic way, we're not saying if you're 50 years old and want to retire at 65, you should go all in on 100% equities, leverage to the moon, where you're seeing huge swings in the markets. We're not saying to do that, but it's important to realize just the power of that compound interest. And it's never too late, but it's always better to start early. So let's go through an example again. Let's say person A starts with investing $10,000 per year, and they're starting at age 25. And let's say that money is earning 6%, and that person wants to retire at 65. And then person B does the same thing. They invest $10,000 per year, but they're going to start at age 35, still earn that 6% return, still retire at age 65. That person A that started just 10 years before, so they have an additional $100,000 of their own money that they had to invest, they're going to end with $1,547,620.
Right.
And you think, okay, person B, okay, they invested 100,000 last, it might be a little bit less than person A. Well, person B is actually only ending with 790,582. That is just the power of compounding interest and why investing early is super important.
Super important. And while it's not too late, I think another point to add there too is that person A in this case, having started to invest much earlier, when they get to those later years of their investing life, when they're 60 or 55 and they have a shorter time horizon now, it allows them, because they've invested earlier, it allows them to take risk off the table.
Yeah.
If they have a shorter time horizon, that might be a point where they say, okay, I've done my, we'll call it risky investing in things like stocks while I was young in my life and I'm still working. And then those next, 5 or 10 years where I'm at the back end of my career of working and investing, I can now afford to take risk off the table and have more assurance for my retirement money to be there when I do decide to retire. In comparison to person B who started 10 years later, they might, if they want to achieve their goals in retirement of accumulating assets and that sort of thing, maybe they have to continue to take levels of risk by investing in things like stocks.
Yeah. Yeah, I think that's a key thing that a lot of people don't really think about is they might talk with their friends about, oh, my advisor got this rate of return or my 401k got this rate of return. Well, you don't always think about performance as just your return. You have to think about the risk you're taking to get that return.
Absolutely.
And just because you're making 20% a year, that doesn't mean that you are doing better than the person making 10. Because if you're up 20 one year, but then you're down 40 the next year, and then up 15 and then down 10 and everything in between, are you really doing better than the person that's earning 5% this year, 8% the next year, down 2% the year after?
Right.
You have to consider the risk you're taking in that portfolio. And within that portfolio, you have to think about the things you're investing in. So stocks, bonds, ETFs, mutual funds, alternatives. And you have to come up with that right allocation between the different asset classes to figure out how much risk am I willing to take to get the return that I need.
Absolutely. And an important thing that you said there that I want to reiterate is that you shouldn't think that you can receive a higher level of return by taking the same level of risk as something that has a lower level of return.
Yep.
Anytime you view an asset or you research an asset or an investment and you see that it potentially has a higher level of return, that should immediately make you think that, okay, I must accept slightly more risk to take on this level of return in this product. And that's absolutely it's a part of our equation when we invest,
Yeah.
and it should absolutely be a part of yours.
Yeah. So I think most people watching are going to understand what a stock is, what a bond is. That goes back years and years, and it's a very general understanding of what markets you can invest in.
Sure.
Another type of investment is something called an alternative. And an alternative is a very broad term. And it's really anything that's not a stock investment, but it's also not a bond investment. It's something completely different than both. And when we look at alternatives, these things could be like private credit, they could be real estate, they could be merger arbitrage. There are a variety of different things that classify under alternatives. But the goal of investing in these alternatives is really uncorrelated returns.
Absolutely. With alternatives, we do see in different products, we see similar returns to something like a bond or a stock, depending on what it is. Private credit, for example, might be more stock-like, whereas merger arbitrage might be more bond-like.
Mm-hmm.
But these things are uncorrelated to traditional stocks and traditional bonds.
Yeah.
So we really we want to carve out a piece of the portfolio for these assets, not make it the whole portfolio, of course. Keep stocks and bonds, but carve out a portion of the assets to fit these things like alternatives that are going to be uncorrelated in years where stocks and bonds both perform poorly.
Yeah.
I think a good example of that is a year like 2022.
Oh, yeah.
In 2022, we see negative double-digit returns for both stocks and bonds. And really an unprecedented year in the history of markets,
Yep.
right? But in that year, something like real estate, private real estate, is actually a positive performer in that year. Something like private credit is actually a positive performer in that year. Again, showing uncorrelation and even negative correlation at times, right? Stocks and bonds down, private credit, private real estate up in a year like 2022.
Yeah.
So, it's that kind of uncorrelation that we want to bring to the portfolio and hopefully have, at least a piece of the portfolio in any given year performing well.
Yeah. And typically these alternatives are actively managed. And when you think about stocks and bonds, these different ETFs or mutual funds, they can be both either passive or active. And I think that's an important distinction that not a lot of people realize what the difference between a passive fund and an active fund is.
Absolutely.
So a passive fund is something like an S&P 500 fund. It's just going to track what the S&P 500 is doing. So if the S&P is up 1%, it's going to be up roughly 1%. There's always a little bit of a tracking error in there, but it's going to be up roughly what the S&P is doing. On the other hand, an active fund is going to have a portfolio manager with a team of analysts, a team of researchers, and they have their own process for investing where they are benchmarking to an index, whether it be the S&P 500, the Russell 2000, the MSCI ACWI, different indices around the world. But instead of just buying and holding what the index is holding, they are buying and selling individual companies that they believe in at certain times. They're going to buy, they're going to hold, they're going to sell. And they are going to be active in that fund to try and either outperform the market, outperform that benchmark, or hopefully lessen the volatility of that fund compared to the market.
Right. And I think an important distinction that you make there is that these funds are buying and selling typically during the year, whereas an index might have a period where they rebalance. They might say, hey, we're going to rebalance once a year. At the end of the year, we're going to recalculate all the stocks in the portfolio, and we're going to rebalance. But an active manager is they're not only rebalancing, but they're buying and selling throughout the year. So there's going to be a higher turnover rate, is what we call it, of the stocks within the portfolio. Now, the interesting thing here is that while an active manager might outperform over time, it's big if, but while they might outperform over time, one thing that we do know is by turning over the portfolio, more actively throughout the year, you incur things like capital gains. You incur not only short-term capital gains, but long-term capital gains.
Yep.
And these funds typically kick out a pretty sizable distribution at the end of the year. Whereas something like an index ETF that tracks an index, it's constituted differently. It's in a different wrapper, and it's more tax efficient. There's typically no capital gains to kick out at the end of the year. Some of them that pay higher dividends have, of course, dividend distributions, but not to the level of these actively managed mutual funds.
Yeah, and you said that these actively managed mutual funds are buying and selling. And you say, does that incur capital gains? Yes, just at the end of the year. So instead of if that fund manager buys and sells in June, you're not paying capital gain in June.
Right.
At the end of the year, they make these what they're called capital gain distributions, that what they bought and sold throughout the year, if they incurred capital gains, they're now distributed at the end of the year. The other side of that is, let's get rid of mutual funds. Let's talk ETFs. ETFs don't buy and sell. What they instead do is swap funds. So that doesn't mean an ETF just owns the same thing the entire year. But what they can do, instead of buying and selling, they can swap one company for another, and that does not incur any capital gains, which is much more tax efficient than a mutual fund.
Absolutely. I think, when we think about long-term investing, not only do we have to take in things like inflation, like when we were talking about the cash scenario, but also the tax impact, right?
Yeah.
If I have the tax, impact on my portfolio, I have to calculate that into my return.
Yeah. And what has been a big rise, I feel like, in the last 10, 15 years are these factor-based funds.
Absolutely.
And these are a lot of times ETFs, so they're like index funds, but instead of just owning the entire index, they are governed by these factors that the ETF follows, whether that be highly profitable. So the ETF might be only looking at highly profitable companies in that index. There's things like low volatility. There's things like momentum. There are a lot of these different factors that these new ETF index funds are following that have proven that can outperform a benchmark over the long term.
Absolutely. And I think, like you said there, if we just buy an index, yes, it is tax efficient, right? But we think of an index like the U.S. Small Cap Index, commonly referred to index as the Russell 2000, U.S. Small Cap Index. Now, what we know through this index is that around 40% of the companies within this index are unprofitable.
Mm-hmm.
Now, has the index done well over time? Yes. But do we think maybe we don't want to invest in 40% of an index that has unprofitable companies? The same thing can be true. So these factor funds, these multi-factor funds that we've started to incorporate in the portfolio, they really try to weed out companies for different factors like that. Like Alex said, profitability. Another one's quality. They can kind of be thought of similarly. And these factors weed out companies for different screens like profitability, and we think that they'll give us better risk-adjusted returns over time, rather than just buying a straight index.
Yeah, so we're going to throw a graphic up here on the screen that shows the different market price and the time, and look at what the market is doing through different business cycles and when factors do well. So when we look at these factor funds, what we really like to do is look at these multi-factor funds, because these multi-factor funds are going to own different factors, and they're going to be governed by not just one, but multiple of these factors that can outperform in different times of the market.
Absolutely. So if we look at this chart, for example, we have four main pieces of this market cycle, this business cycle, this economic cycle. And that's, kind of starting at the top, it's peak. And then, an economy and market contracts. You get to the bottom. Unfortunately, we have troughs. Unfortunately, we have recessions from time to time. And then on the way up, out of the recession or out of the trough, we again experience an expansion and then up to the next peak, right? So during each, we can break these up into kind of four different parts of the cycle. During each of the four parts, we have different factors that perform best. So for example, at the peak, you see Q, G, and M. That can stand for quality, growth, and momentum. That's when, stocks in those sleeves of that factor might outperform. And then as the economy and the market contracts and goes through a trough, again, we start to see things like quality, but now we have another factor called value, and another factor called low investment. These factors point to companies that are on the value side, they're priced lower, and then on the low investment side, they are less inclined to grow. They're not, their growth prospects are not as high. They're not trying to go into a lot of debt to keep the business growing. And value and low investment kind of can go hand in hand. So those sort of things outperform during maybe a contraction or a trough. And then once we pick up on the other side, an expansion, maybe it's quality and momentum. You see an M there for momentum. So things that have been outperforming recently, they tend to outperform during an expansion. Okay. So the point of this chart, though, is that we do not know when cycles are going to start and end. We cannot time it, like we started off talking about. We can't time the market. So we don't want to try to time each factor either. And we want to use a group of these factors that we think are important, things like quality, things like value, things like profitability, and use them together so that over the time, over the whole cycle, we think we can get better performance.
Yeah. And when we talk about these different factors, it really goes hand in hand with portfolio diversification. We want to diversify across these different factors when we're investing, but we also want to diversify across the different asset classes.
Absolutely.
I think a lot of the times we have clients come in and all they want to talk about is the S&P 500. And while the S&P 500 has been performing really well, and we don't ever want to exclude companies or indexes like the S&P 500, but there are more companies in the world than just US large cap companies.
Absolutely.
And while US large cap has outperformed, that doesn't mean it's going to always outperform. Diversifying your portfolio across all the different asset classes, whether that be international stocks, small cap stocks, big cap stocks, US bonds, international bonds. By diversifying, you are going to have better overall performance over the long run than if you just pick and choose one asset class that you believe in. If you just pick and choose one asset class, there are chances that you could outperform, but the chances are you're going to outperform in 1 year and then underperform in the next, and then outperform and then underperform. And it's better to diversify across the different assets. So a good example of this is cash. Mm-hmm. In 2022 was the best performer. We already talked about 2022. A lot of things were negative in 2022. So cash was the best performer. And then if you are trying to time the markets, you might say, oh, look, cash is the best performer. Let me just get into cash and get a little bit of interest so I don't have to worry about the markets. Well, guess what? 2023, cash was the worst performer of all the asset classes.
Right. So I think that's a good point too. When you diversify, you're not only going to have maybe the best of the asset classes in 1 year, but you're also going to have, pieces of the underperforming asset classes in the same year. So from year to year, if you pick the S&P 500, you have to rely on the S&P 500 being the best performer every single year.
Yep.
If you pick a diversified portfolio of things like U.S. stocks, international stocks, maybe some bonds in there, maybe when cash is yielding higher, maybe there's a cash allocation. What we have is those four asset classes really are helping you all at the same time. And if the S&P 500 isn't the best performing index of the year, then maybe it's international that helps bring the portfolio up.
Yeah.
Or you're like 2022 you mentioned, maybe it's cash. So having that diversified portfolio is really important.
Yeah. And a lot of clients come to us and they say, well, what about my 401k? I don't know how to diversify across different asset classes in my 401k. They just give me a list of options. I have no idea what any of these mean. And a lot of the times for a client like that, a good solution would be a target date fund.
Right.
And what that target date fund is, what it essentially accomplishes is you pick a date. So let's say you plan on retiring in 2040. You pick the target date 2040 fund. And there's a little bit more nuance to that because based on your risk tolerance and how much return you need. But for an average person, let's say you pick target date 2040. What that fund then does is it diversifies across all these different asset classes. So we do have large cap, we have mid cap, we've got international, we've got some bonds, and it spreads the money across all those different asset classes. And then what it does is as we get closer to 2040, you're still 100% invested in that fund. That fund is going to become more and more conservative as you reach 2040, and then keep becoming conservative after 2040 has already passed. And what that accomplishes is that asset diversification, as well as reducing the volatility in that portfolio as you get close and into retirement.
Exactly right. And Alec, I'm impressed. I didn't know that you had plans to retire in 2040. Congratulations. It's coming up here in about 15 years or so. But he's absolutely right. What we want to try to do is match the horizon of our life, of our investing goals. We want to try to match that with a duration, what we call duration of our portfolio.
Mm-hmm.
And a target date fund is a great way to do that.
Yeah.
Like you said, over time, it's going to become maybe more conservative, but it's taking the emotion out of it. We go back to our conversation about timing the market. Target date funds are not trying to time the market. They have a systematic way of over time moving you to a more conservative allocation, regardless of what your emotions are. So a target date solution can be a great option. And they're also great for things like 529 plans. If you're anything that you have a set time horizon for, target date funds can be a great option.
Yeah, the 529 is a good example because you can do the same thing if you have kids going to college.
Right.
It's sort of the same concept of when your kid is 1 year old, you can afford to take more risk in that portfolio because you still have about 17 years until they go to college.
That's right. And if you pick a target date fund, by the time they're going to college, you know how it's going to be invested. You know how it's going to move more conservatively, exactly similar to the way your retirement fund would.
Yeah. And one of the things that I think we haven't mentioned yet is something called sequence of return risk. And this is a big risk that a lot of people don't even realize that they have. And essentially what the sequence of return risk is if you are in poor performing markets as you start your retirement and as you start taking those distributions, you are sort of locking in those losses that have a lagging impact on the portfolio for your lifetime. So let's say you accumulate, let's keep going back to that $1 million, and you go to retire and then the market drops 20%. Well, now you're at $800,000 and you start taking money out. You are never going to get that 20% loss back because you started taking those distributions. Someone that is 30 years old and sees a 20% loss, that's not really fazed by them because they just wait it out and eventually the markets are going to turn around and they're going to get that money back. But if you start taking those distributions, you're sort of locking in those losses and it's hard to recover from that.
Exactly right. And this is another point on diversification. If we think of a year like 22 when both stocks or bonds are down, let's say I retire when I'm in 2022. I didn't, unfortunately, but if I retired in 2022 and I have, a 50-50 allocation to stocks and bonds, and I want to start drawing my retirement income off of my portfolio, maybe I have RMDs, that sort of thing. If I start drawing from the stocks that have been drawn down, well, here I am 2 years later in up markets for stocks, and I've now taken off some of the table that I had in stocks to rise that the next 2 years of up markets. So what we want to do is in thinking of sequence of return risk, we have a diversified portfolio. Maybe we start drawing specifically just from the bonds. And that way the bonds, are the less appreciating asset. We've now drawn the bonds down a little bit, but the stocks we've left, the same. And now those stocks get to, recoup the losses that they had in 22 through gains in 23 and 24.
Yeah. So moving on to recent events and current events, market trends.
Sure.
Depending on when you're watching this, we just learned a couple of days ago that the Federal Reserve cut interest rates by 25 basis points.
Right.
And depending again when you're watching this, you might have saw that the market after that announcement was made took a little bit of a dip. And a lot of people think, oh, we're cutting interest rates. Why is the market going down? Well, the market really wasn't affected by the 25 basis point cut. It was more so the chairman, Jerome Powell, what he said in that conference, and that in 2025, we're only expected to see two more cuts. That sent a shock to the market of, okay, we are not going down super low interest rates. We might be seeing these higher interest rates for longer.
Absolutely. And, interest rates have been much higher. But as they come down, businesses say, okay, well, if I want to grow my business, if I want to borrow money to keep growing and that sort of thing, then it's going to be cheaper.
Yep.
Well, if now all of a sudden, maybe it was, we'll say five interest rate cuts were projected in 2025, maybe. Well, now it's only two. Well, now the interest rate level is going to be higher. And if I'm a business, I'm less inclined to grow, or I'm less inclined to take on more debt to do that. So the market views that, and they kind of reprice, and here we are, and the market goes down what 2 or 3% in a day,
Yeah.
and then here we are the day after, and maybe it's it's the emotion of it all, right?
Yeah.
I'm not trying to time it, but we're back up 1.5%, 2% today. So that's a great point. That event, but staying diversified through that event, not trying to time it. It's been a great strategy.
Yeah, and the Fed's going to watch, macroeconomic conditions to sort of determine that. Their projections aren't always what happens. So last month we saw CPI, the inflation rate was up 0.3%. And so the last 12 months it was up 2.7%. That's a little bit higher than what the Fed's target is. But on the other hand, GDP growth is still strong. Q2, we're up 3.1%. Q3, we're up 3%. So the Federal Reserve sort of has a balancing act that they have to consider when they're talking about cutting rates or keeping rates the same.
Right. And the Federal Reserve, they are what they call data dependent. So they're reading the data as it comes in. Now, I'm sure that they pay attention to things that could potentially happen in the future, but they have just said, we want to make interest rate decisions, policy decisions based on what we see the data to actually be.
Yeah.
So, sure, are there things on the horizon that could point to higher inflation? Sure. There are things that maybe could point to, disinflation or the lowering of inflation as well.
Yeah.
And they just don't know. They don't have a crystal ball. We don't have a crystal ball. So they're making decisions based on how they see it. And we just have to, stay allocated through it all.
Yeah. And talking about different market trends, a lot of people always ask us, oh, the Republican Party won, what's going to happen to my portfolio? Or, oh, the Democratic Party won, what's going to happen to my portfolio? And a lot of times we point them that the president really doesn't make a huge impact on the returns of the stock market. The Federal Reserve has a bigger impact on the stock market than presidents do. So if we look here at the S&P 500 performance under Democratic presidents versus Republican presidents, you're going to see markets go up and markets go down. There isn't a huge difference between when a Democrat is in office and a Republican is in office.
That's right. And Schwab did a similar survey, or they did a similar study in analyzing the exact same thing. And I believe they said $10,000 invested during different time periods. So from 1961 to this year, if you invested only during Republican presidents, your portfolio might have been $100,000, let's say. And if you only invested under Democratic presidents, it might have been a little bit higher, maybe $500,000. But if you stayed invested for either side, either party, not staying, apolitical with your investing, then your total accumulation would have been something like 5 or 6 million.
Yeah.
So it's very important, that we take in, regardless of how you feel about any political party, we understand that the investing is somewhat separate, and that staying invested during either party can prove to be the best strategy.
Yeah, that goes back to how we started. Time in the markets is going to be trying to time the markets.
That's right.
So I think with closing thoughts, I think next month we've got how to retire in 2025.
Sure.
So we've got a great webinar coming up next month about moves to make to be able to sort of hone in your retirement for 2025.
Yeah, well, investing is a big portion of that. When you're retiring and you're starting to draw from your income, you want to think about things like your allocation. You want to think about things like potentially adding alternatives, things like, being aware of sequence of return risk, of those sorts of things. And that can better help prepare you for your retirement.
Yeah. So look out for an email from us for that webinar, but any other closing thoughts or any questions for us, just shoot us an email. We'll be happy to answer any questions anyone has.
thank you all, and happy holidays and a happy new year. And thanks for tuning in to Financial Consulate and Alec and myself.
All right, take care, everyone.
Thanks.